Your portfolio is bleeding red right now, and you're about to make the biggest mistake of your investing career. While everyone's panic selling silver after that brutal 3% crash this week, there's one metal sitting at $5.86 per pound that's about to change everything. And the biggest tech companies on Earth are quietly cornering the market before you even realize what's happening. I'm Robert, and what I discovered this afternoon made my hair stand on end. Stick around because in the next few minutes, I'm going to show you why Amazon just bypassed the entire public market to lock in copper supplies directly from Rio Tinto, and why this signals the beginning of the greatest commodity shift in 175 years. This week, gold is down $21. Silver just got absolutely crushed, down over 3% in a single session. Every financial channel is screaming that the metals mania is over, that the commodity supercycle just hit a brick wall. CNBC wants you to believe the party's over. But here's what they're not telling you. While silver experiences this violent emotional flush, while retail traders panic sell their positions, there's one metal displaying the kind of stability that tells me something massive is brewing beneath the surface. Copper. Holding $5.86 per pound like it's welded to the floor. Not rallying. Not mooning. Just holding. And in a market like this, that stability is more telling than any moonshot. Now here's where it gets insane. While you're watching the exit sign, I'm watching the VIP entrance. Amazon Web Services just secured a 2-year direct offtake deal with Rio Tinto. Not through the London Metal Exchange. Not through COMEX. Direct. Samsung's doing the exact same thing. Let me ask you something that should keep you up tonight. If copper is just another industrial commodity about to crash with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates to guarantee delivery? The answer: they know something the public markets haven't priced in yet. Here's my primary claim, and everything in this breakdown builds from here. Copper is no longer a commodity. It's becoming a strategic tech asset that Amazon, Samsung, and every major player in the AI and electrification space are securing before the public markets even wake up to the structural shortage. This isn't about short-term price action. This isn't about riding some hype wave. This is about recognizing a fundamental shift in how the world's most critical infrastructure metal is being valued and allocated. We're witnessing what I call the great decoupling. Silver and gold? They're fear trades. Insurance policies you buy when you're scared the system is breaking. Don't get me wrong, I've stacked physical silver for over a decade. I understand the appeal. But copper? Copper is infrastructure oxygen. It's the metal you need if you're building the future. Every AI data center, every electric vehicle fleet, every renewable energy grid, every piece of technology that's supposed to power the next 20 years of human civilization requires massive amounts of copper. And here's the uncomfortable truth that mainstream financial media refuses to discuss. Supply cannot respond to this demand for at least a decade. Not because of some temporary bottleneck, but because of the fundamental physics of mining. It takes 12 to 15 years to bring a new copper mine online from discovery to production. Ore grades have dropped 30% since 2000. The easy copper has already been pulled out of the ground. Meanwhile, demand is accelerating at a pace that would have seemed insane just 5 years ago. Let me give you the snapshot from this week. Gold, $4,588, down $21. Silver, $28.55, a brutal minus 3.15% dump. The kind of move that makes retail traders question everything. Copper, $5.86 per pound. When you look at the CFD structure for copper, you're seeing a high liquidity battle zone at $5.86. Despite the panic dump in precious metals, despite broader risk-off sentiment, despite every reason for copper to be selling off in sympathy, it's refusing to surrender the $5.50 to $5.80 structural support level. This is tectonic stability. It's not flashy. It's not exciting. But it tells you there are very large hands underneath this market who are not willing to let it break lower. Here's where the paper market and physical market are telling you two completely different stories. While paper traders dump silver contracts, physical giants like AWS are signing 2-year direct offtake deals with Rio Tinto for copper. Amazon Web Services isn't speculating. They're not trying to flip a commodity for quick profit. They're securing multi-year supply contracts because they've done the math on how much copper they need to build and maintain the data center infrastructure that powers their entire business model. And they're willing to bypass public markets entirely to guarantee that supply. This isn't normal behavior during a commodity boom. This is unusual behavior during what the mainstream is calling a commodity crash. So what do they know that the paper markets don't? Now I need to slow down because this next part is the foundation for understanding why this matters. We're going to talk about the copper to gold ratio. I know ratios sound boring, but this ratio is the economic seesaw. And right now that seesaw is tilting in a direction most people aren't prepared for. The copper to gold ratio measures the market's preference between two fundamentally different types of assets. On one side, you have gold, the ultimate defensive asset, the emergency fund, the insurance policy. On the other side, you have copper, the industrial workhorse, the infrastructure metal, the thing you need when you're building the future. Gold is what you buy when you're scared, when you think the system is breaking, when you don't trust currencies. Copper is what you buy when you're building electrical grids, manufacturing EVs, constructing data centers and renewable energy infrastructure. You buy insurance when you're scared. You buy wiring when you're building the future. When the copper-to-gold ratio is falling, it means the market is rotating into defense. People are scared. They're buying gold, selling industrial metals. This typically happens during recessions, financial crises, periods of extreme uncertainty. When the copper-to-gold ratio is rising, it means the market is rotating into offense. People are building, investing in infrastructure, betting on growth. And here's the trap that most precious metals holders are walking into right now. They've been conditioned to see gold and silver as the ultimate safe havens. But when the ratio starts to turn higher, when copper starts to outperform gold, it signals a shift towards cyclical industrial utility assets. If you're holding only defensive assets during that shift, you're positioned for the last war, not the next one. The copper-to-gold ratio just completed what Elliott wave theorists would call an ABC flat correction. The market spent months digesting previous gains, consolidating, building a base. And that correction just ended. The seesaw is tilting. Now we need to run the numbers because if I can't show you the math, then this is just another hot take in a sea of financial noise. A traditional internal combustion engine vehicle uses about 20 kilograms of copper. Your wiring, starter motor, alternator, basic stuff. An electric vehicle uses approximately 80 kilograms of copper. That's 4 times the copper intensity per vehicle. We're not talking about a marginal shift in the auto industry. We're talking about every major automaker on the planet committing to full EV lineups within the next 10 to 15 years. Global auto production, roughly 80 million vehicles per year. If even half of those transition to EVs over the next decade, you're talking about an additional 2.4 million metric tons of copper demand just from the automotive sector alone. But it doesn't stop there. AI data centers are the new wild card that nobody was pricing in 5 years ago. A single large-scale data center can require anywhere from 5,000 to 10,000 metric tons of copper for cooling systems, electrical distribution, backup power, and high-speed interconnects. And we're not building 1 or 2 of these. We're building hundreds. Microsoft, Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. And every single watt of computing power they add requires copper to keep the system from melting down. Then you have renewable energy grids, solar farms, wind installations, grid-scale battery storage. All of it is massively copper-intensive. A single offshore wind turbine uses approximately 8 metric tons of copper. A solar farm uses about 5.5 metric tons per megawatt of capacity. The International Energy Agency has projected that to meet global climate goals, we need to triple renewable energy capacity by 2030. That's not an optimistic forecast. That's the bare minimum to stay on track. When you add up EVs, AI data centers, renewable grids, and baseline industrial demand, you're looking at a multi-decade locked-in demand profile that hasn't existed in human history. This isn't cyclical demand that goes away when the economy slows down. This is structural demand baked into the infrastructure requirements of modern civilization. Now let's talk about the supply side, because this is where it gets uncomfortable. New copper mines take 12 to 15 years to come online from discovery to production. That's not an exaggeration. That's the average timeline when you account for exploration, permitting, environmental reviews, financing, construction, and ramp-up. And here's the kicker: ore grades have dropped 30% since the year 2000. Mining companies have to move 30% more rock to extract the same amount of copper. The easy, high-grade deposits have already been mined. What's left is deeper, lower grade, and more expensive to extract. Let me run a simple stress test. Let's assume global copper demand grows by just 3% per year. That's conservative, given the electrification trends we just discussed. 3% annual growth on current demand of roughly 25 million metric tons per year means we need an additional 750,000 metric tons of new supply every single year just to keep pace. But here's the problem: there aren't enough new mines in the development pipeline to meet that growth. According to the most recent data from S&P Global, the copper industry is facing a cumulative supply deficit of nearly 10 million metric tons by 2030 if current trends continue. 10 million metric tons. That's not a rounding error. That's a structural gap that cannot be bridged by incremental efficiency improvements or recycling alone. Speaking of recycling, let's kill that myth right now. Yes, copper is highly recyclable. About 30% of global copper supply comes from recycled material. But here's what the recycling optimists always leave out. Recycled copper cannot meet the high purity standards required for advanced applications like AI high-speed cooling systems and next-generation EV circuitry. You can't just melt down old pipes and wiring and turn them into semiconductor-grade copper. The metallurgy doesn't work that way. You need virgin material for the most demanding applications. While recycling will continue to play a role in meeting baseline demand, it cannot fill the gap for the high-tech, high-purity applications driving the next wave of demand growth. If you run a discounted cash flow model on copper miners based on a long-term price of $5 per pound, you'd think the market is pricing in plenty of upside, right? Wrong. $5 per pound isn't hype. It's the new floor for a world that requires electrification to survive. When you factor in cost inflation for mining equipment, energy, labor, and regulatory compliance, the all-in sustaining cost for many copper producers is already approaching $4 per pound. That means at $5, you're only looking at a $1 margin. That's not the kind of margin that incentivizes massive capital investment in new projects. For the industry to justify building the mines we need to close the supply gap, copper prices need to be sustainably above $6 or $7 per pound. And the market hasn't priced that in yet. Now let me do something critical. I need to steelman the strongest argument against this thesis, because if I can't defend against the best counter-argument, then I'm just another talking head pumping hopium. Here's the strongest case against this whole thesis: recession will kill demand. A prolonged global manufacturing recession where the PMI stays below 50 for an extended period. If that happens, copper's so-called supercycle is just a debt-driven mirage. All this talk about EVs and AI data centers assumes continued economic growth and massive capital investment. But if credit conditions tighten, if corporate balance sheets come under stress, if governments pull back on green infrastructure spending, then all that projected demand evaporates. This is the bear case. And it's not a straw man. It's a legitimate concern. So let me address it directly. Yes, copper is cyclical. In a severe recession, demand would absolutely take a hit. But here's where the traditional cyclical playbook breaks down. The direct corporate deals prove that tech giants don't care about the PMI. They care about availability. Think about what AWS is doing. They're not speculating on copper prices. They're not trying to time the cycle. They're de-risking their supply chains because they know that if they wait for prices to crash and then try to secure supply, the supply might not be there. This is the key insight that separates this cycle from previous commodity booms. In past cycles, demand was fungible. If the economy slowed down, you could defer projects, delay construction, wait for better conditions. But the infrastructure demands driving copper today are not fungible. They're not optional. If you're Amazon and you need to build a data center to support your AI services, you can't just delay that project indefinitely. Your competitors are building. You're either securing the copper you need now or you're falling behind in the AI race. If you're an automaker and you've committed to transitioning your entire fleet to EVs by 2035, you can't just pause that transition because the economy hit a rough patch. You're locked into massive capital investments, retooling factories, training workers, signing supply agreements. This is what I mean by locked-in demand. Could a deep recession slow the pace of that transition? Sure. Could it delay some projects? Absolutely. But it can't eliminate the structural need for electrification. And here's the critical point. Supply can't respond quickly, even if demand does slow down. If we enter a recession and copper prices soften, what happens? Mining companies cut back on exploration. They delay new projects. They focus on maintaining existing operations rather than expanding capacity. And when the economy recovers, which it eventually will, the supply deficit is even worse than before. This is the supply trap that most people don't appreciate. Unlike manufacturing, where you can idle a factory and bring it back online in a few months, you can't idle a mine development project and restart it quickly. Once you pause a major mining project, you're adding years to the timeline. So the recession argument, while valid for near-term price volatility, actually reinforces the long-term structural case for higher copper prices. So what happens next? Because this isn't just an academic exercise. This is about reading the market in real time and understanding the moves happening beneath the surface. First, I'm watching the LME and COMEX closely for any changes to margin requirements. When physical inventories start declining and volatility increases, exchanges typically respond by raising margin requirements for futures contracts. This is a risk management tool, but it also has the effect of squeezing out speculative leverage. If we start seeing margin requirement increases at the same time that shadow withdrawals are accelerating, that's a signal that the paper market is coming under stress. And when the paper market comes under stress, that's when price discovery starts breaking down. What do I mean by shadow withdrawals? The LME reports inventory levels, but those numbers only tell you what's sitting in registered warehouses. They don't tell you about the copper being pulled into private corporate stockpiles through direct offtake agreements. The AWS deal? That copper isn't going to show up on the LME. The Samsung deal? Not on the exchange. You can have a scenario where official inventories look stable or even slightly elevated while the actual available supply for spot transactions is evaporating. This is what I call moving into a dark inventory phase. The most important metal on Earth won't even be available on public markets because it's already been allocated to long-term corporate contracts. If that sounds far-fetched, go look at what happened in the lithium market over the last few years. Major auto manufacturers signed multi-year direct supply agreements with miners, bypassing the spot market entirely. Copper is heading in the same direction. Now let's talk about the media narrative, because this is where things get interesting from a behavioral psychology standpoint. Expect the financial media to stay laser-focused on silver's volatility. Why? Because volatility generates clicks. Fear generates engagement. A 3% down day in silver is a headline. A steady grind higher in copper over 6 months? That's not a headline. The mainstream media isn't trying to mislead you. They're just optimizing for attention. And attention is drawn to volatility, not to slow structural shifts. So the narrative will be about the metals crash, the end of the commodity supercycle, the retail traders who got caught in the precious metals hype. And while everyone focuses on that narrative, institutions will continue quietly securing copper supply through off-exchange deals. This is the classic misdirection play. Keep the retail crowd focused on the shiny volatile thing while the real move happens in the slow boring thing that nobody's watching. Here's the dashboard I'm personally monitoring to track how this unfolds. Number 1. LME inventory levels. If these continue to drop while corporate direct offtake deals are rising, that's confirmation that the squeeze is moving off exchange. I'm not looking for a dramatic crash in inventories. I'm looking for a steady grinding decline that persists even when prices are flat or slightly lower. That would tell me that price isn't the clearing mechanism anymore. Availability is. Number 2. The $5.50 floor. If copper holds above $5.50 per pound during the next broad market sell-off or risk-off event, that's confirmation that the decoupling is permanent. It would mean copper is no longer trading as a pure cyclical industrial commodity. It's trading as a strategic tech asset with a structural bid underneath it. Number 3. The spread between futures and physical premiums. If you start seeing physical premiums widen significantly above futures prices, that's a signal that the spot market is tighter than the paper market is pricing in. This is what happened in the early stages of the oil super spike in the 2000s. I want to be clear about something. None of this is going to happen overnight. This isn't a GameStop-style short squeeze that explodes in a week. This is a multi-year structural trend that grinds higher in a way that most people won't even notice until it's already happened. The price could chop around between $5 and $6 for months. It could even pull back to $4.50 if we get a sharp recession scare. But the underlying fundamentals, the supply deficit, the corporate positioning, the locked-in demand, those don't change based on short-term volatility. Here's what I think is the most likely scenario for the next 12 to 18 months. We're going to see continued volatility in the precious metals complex. Gold and silver will have big up days and big down days. The retail crowd will get whipsawed. The talking heads will keep calling tops and bottoms. Meanwhile, copper will grind. It'll hold support. It'll have occasional spikes on supply disruption news. But mostly, it'll just not go down. And slowly, quietly, the corporate supply chain managers will keep locking in long-term contracts. The LME inventories will keep declining. The mining companies will keep reporting that new projects are delayed or over budget. And at some point, maybe late 2026, maybe early 2027, the market will wake up to the fact that there's a structural shortage. And that's when the real move happens. Not because of speculation. Not because of a short squeeze. But because the physical market has already been cornered by the institutions. And the price has to adjust to reflect the new reality. That's the playbook I'm watching. Now I need to be very clear about what I'm doing personally with this information. This is not advice. This is not a recommendation. This is just me sharing my own line in the sand, my own triggers, my own plan for how I'm navigating this setup. I'm watching the copper to gold ratio daily. If it continues to turn higher while silver and gold experience volatility, that confirms the rotation from defense to offense is accelerating. I'm watching for copper to hold the $5.50 level during the next risk-off event. If it holds, that's my signal that the decoupling is real and permanent. I'm monitoring LME inventory data weekly for signs of the dark inventory phase accelerating. I'm tracking corporate announcements for any new direct offtake deals, especially from tech companies and automakers. Each new deal is confirmation that the thesis is playing out in real time. Here's what you need to understand. The screen is telling you one story. The shadow market is telling you another. While everyone panics about silver's 3% dump, the biggest corporations on Earth are quietly locking in copper supplies for the next decade. This is the moment copper stops being treated as a commodity and starts being treated as the strategic asset it actually is. The new gold. And the institutions are front-running the public before most people even realize there's a shortage coming. If you found this breakdown valuable, if you want to stay ahead of the narrative instead of reacting to it, make sure you're subscribed to What Happened After. I'm cutting through the noise faster than the mainstream can spin it, bringing you the signals that matter before they become headlines. Drop a comment below and tell me, are you positioned for the metals crash, or are you watching the real move that's happening beneath the surface? Because by the time CNBC figures this out, it'll be too late. You can't print copper mines. And the clock is ticking. I'm Robert, and I'll see you in the next breakdown where we dive even deeper into the trades the institutions don't want you to see. Until then, watch the copper to gold ratio, watch those LME inventories, and stay ahead of the curve.